Shifting gears to macros now. We're now joined by Santanu Sengupta, Chief India Economist at Goldman Sachs. Shantanu, welcome to the show and always a pleasure to speak to you at NDTV Profit as well. This is Hiral on this side. You know, my question coming to you right now is there is lots that's happening right now when it comes to global markets as well in the form of tariffs. You're talking about geopolitical concerns as well. Sometimes you feel that they're easing, sometimes you feel they're probably exploring further. And thirdly, you recently have the IMF, which has come out and upgraded your stance when it comes to India's growth story for FY26, but expecting some bit of moderation when you talk about 27 and 28. With the way the schematics of things are panning out, how are you looking at the entire setup for 2026 as a year first up?
Yeah, thanks for having me on the show. Look, we think that India's growth is going to be resilient going into 2026 or FY27. You've seen a pivot happening in fiscal policy towards the consumer from public capex over the previous 3 or 4 years through the income tax cut and the GST cuts. Overall, the external balances story also remains quite resilient. The reason why you have had a higher growth this year, and compared to that, including the IMF and us and most of consensus is lower growth next year, is because you had a front loading of fiscal expenditure and some front loading of exports to the US. That will dissipate away. But the domestic demand story for us remains resilient. The base consumption, which is the mass consumption, is in a nascent recovery stage. So we think the setup looks okay, and as you pointed out, unprecedented uncertainty really. So you need to reserve some policy ammunition in case you need to react.
So Shantanu, when you're talking about ammunition that you need in the form of policies in the domestic market right now, let's first divide it between the urban and the rural space. A lot of commentary that we're getting from corporates as well right now is that your rural markets are seeing good growth. Urban, it's been quite some time that we're expecting that revival to come in and sustain, but I think that's still on a back burner somewhere. How are you reading the divide between the two when you look at the economic indicators right now?
So that's very consistent with our macro view as well. The part of consumption where we are bullish on is the mass consumer, which is the bottom end, not just rural, but also the lesser income urban, and multiple tailwinds there, right? I mean, you've had a good crop cycle. You're having a lot of transfer payments at the state level going towards women in lower income households. And the GST cuts also at the very bottom end is beneficial for that segment. The upper end, we would divide it into two parts, the middle and the top, which our consumer analysts have been calling affluent India. That has grown at a very rapid pace post the pandemic, and it's slowing down a little bit. So, you're still growing, but it's not as fast as what you're growing post pandemic. The middle is where some concerns are, if you especially look at the job creation, the advent of AI, and what that could mean for that segment of the population, which is where some bit of monetary easing helps. Some amount of fiscal easing through the income tax cuts has helped in deleveraging those balance sheets. It hasn't yet amounted to any consumption because the balance sheet was quite levered at the aggregate level. So we think that some deleveraging is going on there. So the part again that we are confident of, or we think is we are quite bullish on, is the bottom end consumer rather than the middle or the top.
Shantanu, just wanted to understand, I was reading your report and I could see here that you're assuming that the India-US trade deal will happen by the first quarter of calendar year 2026. What if it doesn't happen? How does your GDP estimate change? Because we are already late by around 6 odd months. 6 months back also we were expecting this deal to go through, but it is yet to go through.
Yeah, great question. I mean, look, our assumption is that it's been a long time. You've had a lot of back and forth on the deal. We still think that it gets done by the end of Q1. If it does not, there's some downside risk clearly to our numbers. We are looking at 6.7 for calendar year 26, 6.8% YOY growth for fiscal year 27. I would say there's some downside to those numbers, not just from the trade account, which means that the current account will be slightly wider because you will not be able to export segments like textile or gems and jewelry to the US, and it's difficult to pivot in those sectors very quickly towards other export destinations. But our view also is that that is the case where you will be using some of the reserved policy ammunition, which I was alluding to earlier, which means that in our base case, we think that the RBI is done with the monetary policy easing. We think that 5 quarters is where they hold for the rest of the cycle. But if the trade deal doesn't come through and there are further headwinds to growth that emerges, that is when we think that the RBI can ease further. And the fiscal space can also be used in terms of supporting these sectors like textiles, gems and jewelry, and so on.
Okay. As you were mentioning that if the trade deal doesn't go through, there could be headwinds to growth. But if you look at the recent export data, obviously the export data is somewhat suggested by, supported by the rupee depreciation as well. But at least the export data is not showing much of a big impact coming in post the 50% tariff that has been imposed by the United States. So is it even a game changer now for India? What are your channel checks telling you?
Well, I'll be careful about that. The export data in the first half of the fiscal year is showing very robust growth because you have had a front loading of exports to the US. So if you look at things like machinery imports and capital goods IIP production, that has been on a rise up to about October of this year, and then in decline in the last couple of months. That's because the front loading is already over. So some of this impact of the 50% tariff, the effective rate I would call more like 35% because there are a number of exemptions of these tariffs is showing up in the data now, and it will continue to show up. It is another thing that the overall current account balances and the external balances remain quite healthy, and that is mainly supported by the services exports, which continue to remain quite strong, and remittances until now. So we are looking at about 1% of GDP current account deficit. If you don't have the deal, probably you have a downside of around 20 basis points or a bit more. So continued rupee depreciation would be the path in that kind of a scenario. And our expectation would be that the RBI and the government come out with both monetary and fiscal ammunition.
Okay. So Santanu, here we're talking about the impact when you're seeing in terms of the trade deal happening, not happening, how estimates change, etc. Let's look at the next big event, which is Budget 2026 in the next couple of days. What is it that you're expecting in terms of policy shifts that we spoke about earlier as well, that the government should focus on or will probably focus on as well, gearing up for FY27?
Right. So I think the big change that is going to come around in this budget from what you've seen in the past few years is that the amount of fiscal consolidation will be lower. So you've had 1.6% of GDP fiscal consolidation, 80 basis points each in the previous 2 years. You're going for 40 basis points consolidation in this year. Our sense is that it's going to be less than 40 going into fiscal year 27, which means that the fiscal deficit in our mind is around 4.2 plus minus 10 basis points. And that clearly is a lower drag on growth. We think that the government's pivot that has happened towards the consumer continues, but there's not too much else that the government can really do in terms of taxes, because you've already given the GST cut, you've given the income tax cut. We don't think there's more changes happening there. But this extra room can now be used twofold. A, your capex drag will be lower, and within that capex, you can shift towards defense and railways. And B, if indeed, the scenario we were discussing earlier, indeed the trade deal gets delayed beyond Q1 and goes into the first half of the fiscal year, and there's still uncertainty, you're reserving some of that ammunition to plow into the sectors which are primarily impacted. So right now you can have credit guarantees for these sectors like textiles, gems and jewelry, and so on. Eventually, you might need a bit more of direct fiscal support for those sectors. So that's how we would think about the budget, that broadly you consolidate lesser, you have a bit more room to either do capex within that, surely defense, given the geopolitical landscape, and have some ammunition for the sectors impacted by textile by the U.S. tariffs if the need arises.
Running short of time, but your view when it comes to the Indian rupee with the kind of movement that is happening in the last couple of trading days, where do you see it stabilizing?
Yeah, look, I mean, the uncertainty is quite unprecedented, right? And if you're facing an external shock, not just through the current account, which we discussed earlier, but also flows, I mean, I think all of us know that flows have been quite tepid in India. The right macro response is for the currency to weaken. So we would expect the path for the rupee is higher from here, and the RBI comes in to intervene and stabilize the volatility only. But coming in for very heavy intervention and not allowing it to depreciate when you're facing these external headwinds and you're unsure about flows or the tariff deal, etc., will not be the appropriate policy response in our view. So in our view, it's the right macro response that the RBI is having with the dollar rupee.